Some questions from Sunday's Market Outlook. Why falling DXY is very bearish. Never said it was very bearish. I pointed out that the DXY is currently showing a bearish chart pattern, but never said it was bearish for anything. B, two quick questions. Why is it generally believed that Canada is heading into a recession faster than the U.S.? Does it have anything to do with the fact that nearly 20% of the citizens have arms? Well, I wouldn't say 20% of the citizens. I would say 20% of mortgage holders, which is not 20%, not the same as 20% of citizens have arms, so they cannot raise rates as fast as the U.S. They're a particular type of adjustable rate where you have a fixed payment each month, but you have a variable interest rate. So as the interest rate goes up, the principal component drops until it's zero, meaning your entire payment is interest. That is called the tipping point, where your mortgage now negatively amortizes, which means every month your mortgage balance increases every month. About half of those have already reset. The other half are expected to reset sometime in the next 6 months, and that will take consumer spending out of the economy. When we say a higher probability of recession, it's never one thing that we point to. These are all indicators that have some history of showing up before recessions, but not all always. Maybe 20 things that you look at, say, well, these 20 things are indicators, but for each recession, we usually see 14, 15 of the 20. It's a matter of how many of the indicators are suggesting that. If you only have one indicator out of 20 saying recession, well, it's sure, it's an indicator of a recession, but it's only one, right? We got a lot. Now, we got much higher levels of household debt versus income, so every increase in interest rates, especially on credit cards, is going to be a problem. Deeper curve inversions on our government yield curve, decelerating real GDP. We had 0.8% quarter over quarter last quarter versus 2.6 for the U.S. So the U.S. has been doing this. We've been doing this. Our retail sales for our last report for retail sales was roughly on par with CPI, which is showing 0% real growth versus positive growth for the U.S. And we will see that down here. Do you know of retail level data providers for market positioning intelligence, such as order flow data, short flows? That is high speed data. That's more for day traders, and I've never really been into that, so I've never cared to look for that. So my answer there is I don't know. C, given the retail sales data point is represented through dollar and inflation, would inflate that number, how can we parse through the data to see whether it shows real consumer strength instead of being a misleading data point that may indicate consumer weakness due to inflation? Well, you can compare the month-over-month inflation with CPI with the month-over-month increase in retail sales. 0.4 annualized is a 4.9%. Retail sales month over month, decimal place is in the wrong place, was a 1.219%. If you annualize that, you get to 15.65. That is still a little misleading because in CPI, the goods number was negative 0.4. In retail sales, you're not going to find things that you can't buy at the retail counter, like housing, for example. So we have to adjust for that. So if you look at the services component of CPI, it had the higher inflation month over month, or the higher price level increases month over month. So this 0.4 is overstating the month over month inflation in the same types of things that would show up in retail sales. So this should be lower. Versus 15.65. Look at the difference between the two. You definitely have real growth in categories. Now, what you can do with CPI is you can go to one of the categories, one of the line items, let's say furniture, for example, and you could look at the price change for furniture month over month. Then you can go to retail sales and look for the same category and look at the change month over month, and you can compare the two changes at that level month over month. But I think you'll find that the retail sales report was a strong report. Isn't a 3-month 10-year inversion a good thing right now? Short-term rates, 1 to 6 months, are directly linked to Fed rates, and long-term rates are reflecting future expectations for, we'll just say, inflation. The higher short-term rates are, the lower expectations for future inflation. If the central, well, we should add here, if the central bank is credible, right? If the central bank is not credible, you would not get that expectation. If the central bank is credible, which the Fed is, thus lower long-term rates. So actually 1 to 6 month to 10-year inversions are good for us, or are a good sign for us. Not that they're good for us, they're a good sign. You can look at it that way. You can look at an economy that's growing and it's flattening out and going sideways, and then suddenly starts to take off again because inflation comes under control and the central bank starts to lower interest rates before it kills the economy and you get a soft landing. But if the central bank continues to raise rates to the point where it constricts demand, where you start getting negative GDP growth, well, then you can have a mild recession. If it makes a policy mistake and it doesn't lower rates or continues with higher rates, you could get a moderate recession. A mild recession is like negative 0.5% drop, or up to negative 0.5. Moderate is, I forget the ranges, but there is a range, and then more than a certain amount you get what's called a severe recession. So, we're somewhere in here right now. It's a coin toss, basically. Are we going to have a soft landing or a mild recession? No one, I think, is saying, oh, there's going to be a very deep and long, severe recession. Well, I shouldn't say no one. It's a small percentage that is saying that, because you gotta get from one point to another point, right? What's going to happen first is you would experience the beginning of a contraction, a mild recession, before you start to say, oh no, it's going to be something deeper than that. At this point in time, there's no visibility. Is it going to be a slowdown? That would be consistent with inverted curves, as long as the Fed, plans that out very carefully. Or is it going to be a mild recession, meaning that, well, they kept rates a little high for too long and it destroyed too much demand? It's hard to do when these interest rates work with a lag. Is by the time you get to April or May, the higher interest rates may have caught up with the economy and affected much more than you thought it would. So the jury's out right now. So it can be seen as a sign of a soft landing, or it can be seen as a sign of an impending recession. Until we get more and more data, we just don't know. Okay, first one here. What is your opinion about modern monetary theory? And I don't think I've ever given my opinion on this before. So it's a good question. To be clear, before we read this, let's make sure we understand what MMT proposes. It doesn't say that a government should just print money. What it's saying is that if a government is going to issue debt in its own currency, it should not be concerned about the level of debt that it issues, because it can always just print money to pay for it. The company can't go broke if it's issuing debt in its own currency, unless it decides that it doesn't want to pay it. That's the only end result. Such that if a country needs money, it should not be concerned about issuing debt in its own currency. And that is the word that it reads over very, very quickly. If they need to spend some money that they don't have, go ahead and issue debt in your own currency, and there you've got it. Well, there's a big assumption wrapped up in need. If you have access to unlimited funds, your needs will grow. Things that are wants will become needs. And then after a while, when those wants are firmly needs, new wants will show up that become needs. And then new wants will show up that become needs. And your needs will grow and grow and grow and grow. To include things that you never would have included in a need to begin with. You would have said, well, that's desirable. But let's face it, we have so much revenue in our country, and we have to, run the country, that it would be nice to pay for that. It would be nice to give all our citizens $100,000 a year in income, and no one would have to work. But it's unrealistic. It would be nice. Well, when you have unlimited printing, that moves closer and closer and closer to a need, such that somebody someday stands up and says, our citizens need $100,000 in government income. It becomes a need. We all grow into our income. If I asked you to make a budget for the year of your needs, which includes socialization, which includes saving for your pension, all that kind of thing, you might say, I need $60K. Okay, let's get a job that pays $60K after tax and it'll meet all your needs. Well, what if you get one that pays $100K? It's 40 more than your needs. You can start fulfilling your wants. I come back in a couple of years, these wants are now needs because you can't give them up now. And so you have to keep making more money, but the more money you make, the more your needs grow. If you have unlimited printing, a government's needs will grow and grow and grow, and there'll be no stopping it because the party that decides to stop it won't get reelected. And if you want to keep power, if you're interested in only yourself, which most politicians are interested in power and themselves, very few are interested in serving the public. Very few. They're primarily self-interested. Then they will use the budget to buy their votes all the time by making your wants their needs. And on and on and on we go. That's the danger of modern monetary theory, is politicians are in charge of it. Right away, that's the end of the story. Full stop. That's over. If it is something behind glass, where you say break glass in case of emergency, and you then issue debt to meet your needs that you have that you can't otherwise meet, I'm all on board for that. But once you open this glass and you start, your needs also increase as well. So there is no end to it other than pure destruction of the value of your currency. So I don't know if we need to read the rest of this, but I've given you my opinion on modern monetary theory, and I think the rest of it is just talking about your country and my view on MMT. It sounds good, but you have to look at the word need and understand psychologically what happens to people when their needs are no longer constrained by their budget. Their needs increase. As a suggestion for your applied series course, it will be interesting to shoot videos that teach how to monitor the main portfolio risk measures, DDB, margin, NAV, theta, over the course of a month. One sequence of videos you made showed a management on a position level in the options course. I'm kind of afraid to keep selling SPY and puts to adjust my desired portfolio DDB, since I don't have all the time in the market knowledge and specifically experience that you have. I don't want to go bankrupt. Well, there are other ways to change your portfolio statistics. If you want to lower your market exposure risk, you can hold cash. You can sell certain high beta positions and move into low beta positions. You can move into sectors of the economy that are less sensitive to economic slowdowns and downturns, like consumer staples, utilities. Healthcare is a good one to be in as well. That you don't always have to be selling something or putting on positions that could be dangerous. I do it because I'm comfortable with it. I do it because I'm at the level of experience now where I can always work my way out of a bad situation if things go bad. Plus, it's not as if I wake up one day and go, oh my God, what happened? I see it unfolding. So I can take action during the course of the day or the course of the week. If that's not you, then you stick with the simple stuff. Is when you think the economy is weakening or the market's going to weak, move into low beta issues and use more debt. When I say use more debt, that means buy bonds. Mortgage-backed securities pay very well. Short-term T-bills pay quite well right now, given the high interest rate on the short end of the curve. There's lots of things that you can do other than just sell puts or sell calls. Again, I use it. It's a technique I use because it's quick, it's fast, and I know what I'm doing. If you're not comfortable with it, then you do have to transact in the underlying securities. Look, I'm going to sell my small cap, high growth stocks if I think that things are going to go bad, and I'm going to get into some large cap value stocks. Yeah, they may go down, but they won't go down as much as the market will. F, I had a question about inflation and how M1 prints impact inflation readings. As the pandemic hit in March 2020, total M1 was at 4 trillion. Now November 22, we are sitting around 20 trillion. That's true. If we printed 80% of all the money in this country in the span of a year or so, when we say all of the money in this country, loose language there. I don't like the way that's worded. How has CPI not spiked well above the peak rate of 9%? Does the M1 not propagate to industries and assets that are quantified for CPI? Well, there's a whole bunch of money that's just not being spent. I mean, just look at the reverse repo operations. There's $2 trillion a day of money that banks have that it's not being lent out. They have no place to put it. It's not earning any return, so they use reverse repos. To answer this question, I'm going to show you a site that does answer the question for you. It's one of the Federal Reserve banks that answers the question, because it is a question that has arisen, and they answer the exact question you ask. Okay, this is from the St. Louis Fed. What's behind the recent surge in the M1 money supply? And there's, I think, enough here to help answer your question. So I will leave this link in the description box. Will you be releasing a 2023 investment outlook with your thoughts, bets on asset classes, industries, and when? Probably not, because last year at this time, I wasn't doing the weekly updates. I am doing the weekly updates, and within them, I am already talking about where I want to be over the next year. And I've been very vocal with home builders. I think that is, once rates have stopped rising and starting to drop, we're already seeing mortgage rates starting to drop. I think home builders are going to do very well because there's a structural shortage. Same with mortgage REITs. I think mortgage REITs will do very well because rates will begin to drop, and the spread between the MBS and the 10-year Treasury will begin to contract. That's a double bonus for mortgage REITs. So each week or every couple of weeks, I do have some interesting thing that I think is great to start seeding the next field, and those are two so far. Where can we find sources of your figures for the yield at the beginning of the video? Go to treasury.gov, and on the menu you'll see data. Open up data and you will see yields. If you look at any Market Outlook video, it's one of the first few links in the description box. We'll take you right to treasury.gov. Is there any disadvantage in hedging currency exposure on a position using Forex as opposed to futures? I think you mean spot, right? As to use spot as opposed to futures. Yes, there is. For a futures contract, the rate is the rate or the price of the futures is arrived at by using interbank rates for both currencies. For spot, that's not the case. It's a spot transaction. So let's say I was doing US CAD. I might get a positive CAD exposure in my account, but I'll have negative USD. And unless I'm investing this CAD in some kind of short-term Canadian Treasury, I'm going to get a lower rate than the interactive brokers will pay me a lower rate than the interbank rate, but charge me a higher rate than the interbank rate on the US. So the interest rate differential on the cash position is far greater than the interest rate differential on the futures. It's that interest rate differential that's going to cost you money. And remember, Forex is highly leveraged. So $100,000 might cost you $2,500, but the interest rate differential alone might cost you $3,500 over the course of a year, which is way more than the margin you put in. So your margin could be wiped out and then some just with the interest rate differential on the positions you have. So where possible, you should hedge using a futures contract as opposed to spot. But futures only come in certain quantities, and you may not have that much exposure to hedge. And if that's the case, then you may want to be very particular about what currencies you want exposure to, because now you have two bets at the same time. If you try to hedge it out, you run into the mismatch in your account of the positive and negative currencies, and you will be charged interest on one that exceeds the rate of interest that would be in the futures, and you'll receive interest on the other that is way below the interest that's wrapped up in the futures. With a market-weighted global equity ETF, that has lots of holdings all over the world, how likely is it that it would trade at a discount to net asset value for a prolonged period of time? It's likely, because you have time zones, right? And these time zones may overlap like this. So that at any given time, you don't have a true net asset value, because you may have, in this market here, you may have observable prices that you can see, but this market is closed and this market is closed. But some event has happened in the world that has changed the level of risk globally. So this market may be up considerably, but you have stale prices in these markets. Now, you may be able to come up with model-driven prices in these markets, but until these markets open, they can't be reflected in the ETF. And if you have some emerging market allocations, you might have some in here which have very low liquidity, such that when the market closes at 4 o'clock, the last price you had was at 3 o'clock, because that particular stock or whatever it was didn't trade for the last hour, but something happened which causes all markets to really decline in the last hour. You'd have a stale pricing. So there's a whole bunch of reasons why you would not trade directly at NAV. Now, that can be arbed away. The sponsor and there's certain market makers that are allowed to create and redeem ETF shares. To replicate the creation basket might not be possible over multiple markets, so that the harder it is to arb it away because of differences in when markets are open versus closed, the more likely you are going to get deviations from net asset value for possibly prolonged periods of time. Apologies if you answered this before. What do you use to analyze your past performance? Holdings-based or transactions-based? Well, I don't have to report to anybody. I don't have to analyze anything. If I had to report my performance to my shareholders, then I have to worry about what I use to analyze my performance. All I really do is say, I started the year with this much, I ended the year with this much. What percentage is that? That's all I have to do. I don't have to report it to anyone. What are your thoughts on stepping into healthcare REITs, MPW, medical properties, instead of companies in the healthcare sector as probability of recession increases? If healthcare sector is good to be in during a slowdown, would healthcare REITs not be as well? Well, it's a difference in what you're doing, right? So the tenant is one thing. The tenant may be recession proof, but you're the landlord. So you're renting buildings to these places, triple net leases. So you have to analyze it like you would analyze any other real estate. How long are these leases? They tend to be longer leases. If inflation is running well above trend, do the step up in the leases keep pace with inflation, or are they too low? So you'd have to look at certain companies and say, well, are their rents above market or below? And if they're below market, are they below market because of some structural issue with the lease that says they can only raise it so much per year, which is fairly common, that if you can only raise the rent so much per year, market rents may accelerate well beyond what you're getting in rent. Also, because it's rental income, which is fairly stable, it's very bond-like. The REIT itself will trade almost like a bond-like component, which means if interest rates go higher, the present value of all those cash flows go lower, because they are like coupon payments. Your rent payment is contractual, right? It's not like earnings per share for a company where if the economy does really well, it can do really well. If the economy does really well, it gets the same amount of rent per month. So even though the tenant may be doing well, the rent, because it's not a percentage of the success of the tenant, it's a fixed amount per month. It doesn't matter how well the tenant does. You could have a building full of billionaires and you're still only going to get your rent every single month. And if your rent won't increase at the rate of inflation, you will underperform. If interest rates are going up, you will underperform. So the REITs in the healthcare space are not the same thing as companies in the healthcare space. They are still just REITs. They're still just real estate. They're still just a property with a lease. S&P 500 12-month forward dividend yield is about 2%. 12-month forward earnings yield about 6%. A little less than that, but yeah, when you compare it with US 2-year benchmark yield or the 1-year forward 1-year yield of 4.5, equity markets don't look that good compared to bonds. So if you take 1 divided by the market PE, you'll get an earnings yield. Right now it's sitting at about 5.7 to 5.8%. And you can compare that with 4.5%. The 2-year right now is 4.49. So you think, well, to be in equities, I'm only getting a little bit more. But when you buy a 2-year bond, if you hold it to maturity, you will realize a 4.49% yield to maturity. However, earnings can go up or down. I mean, that is the yield today. You can have earnings dramatically increase, which means that you have far more upside than what the 5.7 to 5.9% is. So you could also have, the forecast of an improved earnings environment a year out, and the market would increase today in anticipation of that. That's what's not taken into account. For the bond, your principal is constant. It's going to be whatever the face value is, and your coupon is constant. So if you hold it to maturity, this is all you can get, is 4.49. Not so much in the market, but when you're just comparing the two, if you have a 1-year holding period, you might say, well, look, I'm going to get 4.49 with no risk, or I'll get 5.7 to 5.8 with risk. And there's no guarantee you'll get 5.7 or 5.8. Let's say the earnings yield is that. That doesn't mean stock prices won't drop. It doesn't mean you will get that. So a better way to think about it is in terms of a distribution. Here's your 2-year distribution. Right, there's your 4.49. Here is your distribution for equities. Here is your 5.7%. There's 4.9. You're not going to get too much on the upside, but you're not going to get anything on the downside. Here, you have potential upside, but you also have potential downside. It's just a wider distribution of possibilities. In regard to yield inversions, does it mean people buy longer-term T-bills, 10 years over 3 months? Well, because the 3-month rate and the 10-year rate are market determined, it would mean that there is more, that money is going into the 10-year or is accepting a higher yield on the 10-year than it is on the 3-month. I shouldn't say that more money is going into one or the other. We really don't know. It's just that the market is willing to accept a lower yield on the 10-year. If you were to buy T-bills at auctions, well, you can't. There are certain banks that can buy at auctions, that can submit bids at auctions. When you buy a bond, you're buying it from a dealer, not at auction. How do you guesstimate? Well, there is no guesstimating. How do you guesstimate the yield? Well, you'll be quoted a price, and from the price, there'll be a yield associated with that is mathematically derived. It's not a guesstimate. How to smartly pick the duration now and later when rates begin to drop. Well, if rates are going to drop, based on your question, I think you have a lack of understanding of how the fixed income market works. So you might be confusing duration with maturity. And while they are related, they are not the same thing. Maturity is a length of time. Duration is a sensitivity. A percentage change in the price of bond for a percentage change in rates. And if rates are dropping, bond prices increase. So if you expect bond prices to drop, you want a bond with a very high duration. That typically means one with a longer maturity. So you would just buy longer term bonds like 20-year or 30-year bonds. Even if you don't plan to hold it for 30 years, just the price change on a 30-year bond will be greater than the price change on, let's say, a 2-year bond. Can you explain the importance of LIBOR as a reference rate in U.S. markets? No, it wasn't as important now as it used to be. It's an interbank rate. It's what banks will lend each other money for on an unsecured basis. LIBOR is the short-term borrowing rate between English banks. Not really. I mean, it's called the London, L meaning London, but it is quoted in, I believe, 7 tenors and 5 currencies. So it is quoted for more than one currency. And there are different interbank rates. Eurobor, I think there's Tibor for Japan. There's one specifically for India. I don't know. It's something Bor for India. How does that become a relevant reference rate for U.S. funding? Well, because it is quoted in U.S. terms as well. But it doesn't matter. It's disappearing. So, there's no point in learning a lot about LIBOR now, because in 6 months, 7 months, it's gone. What are the purpose of these market updates? Is it intended to potential CFA students? If so, would you match parts of your updates to the relevant part of the CFA curriculum, ideally per level? Hard to do, because some things, I'll talk about do have reference to level 1, level 2, and level 3 all at the same time, that you may understand something. So for instance, I always start with the rates, with the par rates on constant maturity treasuries. Well, you see that in level 1 fixed income, the par curve. You're introduced to the par, the spot, and the forward curve. Well, the rates we're looking at are on the par curve. You see it again at level 2, the idea of what par rates are, and par rates are important for something called effective duration, right? Effective duration measures the percentage change in the price of bond for a change in the par curve. And it is something that you should be very familiar with at level 3. So it's hard to bring any one thing down to any one specific level. As you go through the CFA curriculum, you'll recognize, by the time you're done level 3, you should recognize pretty much everything I'm talking about. It's not just for CFA students, although any CFA student, I think, would understand what I'm talking about much quicker. And it's also a nice complement to the CFA curriculum, because it then shows you how all of this stuff applies directly in the market. So it's more of the applied side of what you see, hence the whole idea behind the applied series, right? This is part of the applied series, but the publicly facing part of the applied series. So I am speaking, when I do these updates, I am speaking to a more sophisticated retail investor. It is sort of more of a professional retail investor. And I know that word doesn't really work very well, but professional means anything you do to make money at. Amateur is you don't get paid for what you do. When we think about a professional retail investor, it kind of is an oxymoron, because how can you be a professional if you're just doing it for yourself? But it means that you are making a living at this, that it is a business model that you're pursuing, is your approach to the market. So I am speaking to that group of people, along with newly minted institutional analysts and institutional investors who may not have the language down right, or may not have a holistic view of the market, that may need just to hear something every now and then and go, okay, just a nudge in the right direction until they're off and running on their own. So that is the purpose of it. Let's see. FIFA World Cup is going to be in North America 2026. It might be the biggest event of the decade. I don't know. Is it the biggest event of the decade? Why is the North American FIFA going to be the biggest event of the decade? I don't know that. Which means real estate is likely to be booming during that period of time in the U.S. Why? Canada and Mexico. Why would real estate be booming? I'm not getting that connection. We have lots of stadiums. It's not as if stadiums need to be built, or hotels need to be built, or housing needs to be built, or anything like that. We got plenty of that stuff. All the infrastructure's in place. So I'm not sure why it would lead to a boom in real estate. I know it's still a long time before that happens, but things getting priced in too quickly. So I was just wondering, how would you position yourself to take advantage of that? I don't know that I would. I don't see it as something. Okay, so it's going to be here. Wouldn't airlines, hotels, like as soon as you figure out what city everything is being played in, or what are the cities that they're being played in, wouldn't airlines, hotels, Airbnb be the thing that you'd want to look at? I don't know that it would affect real estate very much, because nothing needs to be built. I don't know that haven't heard anything about specific stadiums being built or specific areas being built up for this. And if there are, well, it's probably going to be private, government and private, which means you're probably not going to get much of a chance to get in on it. I would seem to think that airlines and hotels figure out what city it's in, what's the major hub in that city. So each city has a particular airline that's the where that's its main port. They'd probably see heightened traffic. Lots of money coming into the U.S. in terms of international travel, hotels, Airbnb. Beyond that, I'm not seeing the connection to real estate. Okay, in the applied options course and on the short strangle lesson, can you please walk through how to calculate time value? Time value is simple. It is, let's say, you first have to calculate your intrinsic value. So your intrinsic value is going to be the stock price minus your strike price, whichever way, for calls or puts. So let's say a stock price is $65 and you sold a $64 call for $4. Well, it's already in the money by $1, so time value is 3, right? Because 64 to 65 is the intrinsic value of the option, and everything more is time value. That's it. And just multiply it by 100, because each options contract is for 100 shares. That's it. It's just the component of the option that is out of the money. You mentioned before that you have outperformed the broad market index over a period of multiple years. However, using the index as a benchmark would not be appropriate if someone is using other securities than the components of SPY. That is true. Outperformance would, in theory, only be possible by being long, by being underweight or overweight different components of the index. That is true. That's exactly what it is. So if I say that my benchmark is SPY, and at the end of the year I say I did 20%, the index did 5%, I beat the index. You may say, well, hang on a second, let's see what you bought. And you found that I was way outside the index. I was buying small cap growth, a few lottery tickets. I was buying units. Buying units means you're buying options that are way out of the money, call options with deltas of less than 0.1, hoping for them to pay off, and I got 20%. You'd say, well, you said your benchmark was SPY, but that is not your real benchmark. This is your stated benchmark. Your true benchmark is something different. So if I have a certain style, is it possible to construct a passive product that matches my style? And if it is, can I beat that? That is called beating your benchmark. I, in essence, don't have a benchmark. So to beat a benchmark like SPY is not difficult, because I can travel way outside the benchmark to get it done. Perhaps you could clear up some misconceptions about the topic of outperforming an index. The common belief I run into is that passive index investing is superior to active management. There's no better risk return reward than following the index. The biggest argument to support this: active managers cannot generate consistent alpha over a long-term horizon without adding additional risk to their portfolios. If when you're passive, when you're indexing passively, here is the portfolio of stocks that you have. Somebody says, well, I can beat that passive index. If all you're going to do is hold this, I can do better than this with this. Meaning I'll overweight this, I'll underweight this, I'll get rid of this one altogether. And you're just going to pick winners and losers. In other words, if the index returns 7%, your job is to say, well, which securities will do better than 7%? Which securities will do worse than 7%? And you'll underweight those and overweight the others. Very difficult to do on a consistent basis. That is active investing. Active investing doesn't mean do whatever the hell you want. It means do what you can within the confines of what you're given. This index is your entire investing universe. You can only make decisions in there. Oh, and to make sure that there is no risk, you're going to have a whole bunch of other rules as well. No short positions. So you can't have any short positions, which means the best you can do if you think a stock is going to suck is just not hold it. You can't really use all the information you have. You may be less than 10% in any one sector. You may have position sizes that are no more than plus or minus 5% difference from whatever the index weighting happens to be. So if the index weighting is 1%, you can be either 0.95 or 1.05. So you may have a whole bunch of rules as well that you look at and say, well, it's almost impossible for me to win at this point. I would have to be right on almost everything. So yes, active management is tough. A lot of times because the IPS ties your hands behind your back and says you can't take advantage of all of the knowledge that you have. I would say this is true for most big funds that are exposed to rules and regulations, yes. The flexible retail investor is not the same, though. Retail investors can capitalize on small market efficiencies, true. Use options to manage risk, true. Generate extra income by conservatively selling parts of the distribution unlikely to happen, true. What is your view on this? Would you say that generating higher returns in the index is possible on a risk-adjusted basis? Absolutely. That is a why. Yes, it is. If yes, how can retail investors achieve this? Well, you just said it, all here. So the defense, the passive investor would come back with a defense saying, oh, hang on a second though. That's the SPY is clearly not your index then. It's not your benchmark. So you can't say you beat the SPY. Lots of investors can beat the SPY if they're allowed to invest outside of the SPY. Sure you can. But do it with just the 505 stocks that are in there without using options. Well, now that becomes brutally hard, right? But yeah, you can do that because there are all sorts of things that you can do. So it is closer to what a hedge fund style would be. So hedge funds have no benchmark in the sense that they try to beat some benchmark. Whenever you have a benchmark, you're investing on a relative basis. So your performance is relative to something else. So if the market is down 20% and you're down 10%, bonus time. However, for a hedge fund to be down 10%, that would be bad news because hedge funds don't invest on a relative basis. They invest on an absolute basis, which is what we as retail investors would like to do as well, invest on an absolute basis. So our benchmark should be something like, let's say, the 2-year plus 500 basis points. So if the 2-year rate is going up, well, you can get more and more return from the 2-year. So that means if you're going to do something with risk, you got to at least get that. And then 500 basis points for risk. Why? That is a high yield spread. And you might say, well, yeah, but I can get that with just a high yield bond. I can go into the top end of high yield. So you might say, well, okay, then 800, 2-year plus 800 basis points. Would be the hurdle rate or would be your benchmark. 8% is a common benchmark that is used, or a common hurdle rate that is used, that the first 8% goes to the investors, and then only after that is there a performance basis for investors in hedge funds. But it would be something like that. It would be something that you can easily get somewhere else. So 200 plus 500 basis points is the same return that you would get on, let's say, a high-yield corporate bond, a 2-year high-yield corporate bond, or if you're looking at a 5-year corporate bond rate, whatever number you want to come up with. High yield is high risk, so maybe your strategy follows along that. And then you have an absolute benchmark return because this spread will always be positive and the yield on the bond will always be positive as well, which means you'll have a positive return all the time. And then you don't have to worry about investing outside of the benchmark because your benchmark is a rate of return as opposed to a universe of stocks. I know you've covered this before, either in the market update or Q&A, but can't remember when. If I want to buy long-dated calls for an ETF instead of outright buying the ETF, is this formula correct? Assuming I want to buy 50,000 worth of ABC at a current price of 75, I would need 667 shares. If I buy call options at a delta of 0.5, then each contract gives me the equivalent of 50 shares, so I would need to buy 13 contracts to get roughly the same position. And this would be dynamic as the delta changes. I may need to buy more, sell to maintain the equivalent of 667 shares. Yeah, if you want to continually buy and sell, if you don't mind the transaction costs with getting that done. The other way of doing it is say, well, 667, there's 7 contracts. Because one thing I will tell you is you will end with 7 contracts. If you hold this all the way to expiration and it's in the money, you will end with 7 contracts, because let's say here's expiration, as we move closer to expiration, the deltas will move closer to 0 or 1. So if it's in the money and it's moving more towards 1, whatever you start with, you will end with 7 contracts, 6 or 7 contracts if you want to have the same amount. My thinking is it's probably better to start with 7 contracts. And if the price pulls back, then you can add a couple more contracts at a lower price to lower the average cost of each of your contracts, as opposed to starting with 13 contracts all at once. If you feel fairly confident in the 7 that you have, and you feel that you want to lean into it, you can always add more. But you will end with 7. So you can avoid a lot of the buying and selling as the delta changes by simply just saying, if I plan to hold it to expiration, 7 contracts will be just fine. If it's just that you don't want to put out 50,000, you want to put out something less than 50,000, this is a smarter way to do it. It'll cost you less to get 7 contracts, and you will, in the end, at expiration, have the same payoff as if you were holding 667 shares, less, of course, whatever it cost you to get done. If you put out a little bit more money, you can, as the price is rising, you can at some point start to sell puts. If you think that, well, it's not going to contract, or as price increases, there are always these reversals of the main trend. You can use these reversals to sell enough puts to perfectly pay for the call, so that you will get the same return as 700 shares. So I don't know that I'd be too eager to get 667 delta on day 1 if I want 667 delta on day 0. I know I'm only going to be paring down my position, and if I'm wrong, I'm losing on 13 contracts as opposed to 7 contracts. If we are about to reach the peak and level off interest rates in Canada and the US in the next 6 to 12 months, is there an argument to start reaching for duration or yield with a buy and hold strategy? Yeah, you could. If you think that we are near the end of the rate hiking cycle. I would seem to want to wait till a little bit past December, and then I'd probably be only interested in 2-year. I don't know that I would go out any longer than that, because to be out of the market for longer than 2 years doesn't make sense to me, because I think while you might have a sideways market next year, the year after I think will be very good, and I don't want to be stuck in a bond with a 3.3% yield if the S&P is going to deliver 18% return in 2024. So I would probably wait till after the December meeting. You get a rate increase, which would set the 2-year yield. You'll get some idea of how many more rate increases the Fed might be thinking about in that press conference. Buy the 2-year, hold it for a year. It'll have a low duration, which means when you sell out of it, you'll get very close to market value without duration killing you, because it'll have very low duration. And then move into equities. I don't know about a 10-year bond. If one were interested in taking a buy and hold strategy on medium long-term bond, would you advocate for a small investor to buy actual bonds? Yeah, buy actual bonds. On IBKR. If you're buying an ETF, they have to sell bonds, right? Because they have to target a particular duration. That's the point of what they're doing. They have constrained duration. So duration is high as a certain number and as low as a certain number. So they don't realize the yield to maturity. So if bonds are losing value during that period of duration that they have, that they're constrained with, well, then you simply get a loss. So you'd want to buy the actual bond, but you'd want to buy short term because you have an inverted yield curve. Your highest yields are at the short end of the curve. What is the optimal way to select stocks or do bottom-up analysis? I don't know that there's an optimal way. In the cross-security risk reversal video, you said you typically go to the fundamental, explore, and interactive brokers and check the analyst ratings because these analysts follow the stock and have a lot more knowledge than retail traders. It's a good starting point to when you are introduced to a stock and you want to get a very high-level view of it. The fundamental, explore, interactive brokers is pretty good. It gives you a whole bunch of different viewpoints on it. It gives you all the financials. You can look at the analyst ratings. You can look at how old those analyst ratings are. And it gives you a consensus target price, which is the average of all the analysts. Well, you're never going to know as much as them on this unless this stock becomes your life for the next 4 or 5 years. Same with the sector, has to become your life for the next 4 or 5 years. Then you'll get as wise as they are in that particular stock. But any one analyst could be too bullish, too bearish, maybe not care too much. So if there's a following of 14 analysts and they all have a target price and you take the average of their target price, that's probably pretty good. I don't know that you would do better than that, nor would I suggest a retail trader attempt to do a 10-year cash flow forecast and forecast every item of the income statement and then do a discounted cash flow, figuring out what their weighted average cost of capital is to come up with a target price. Way outside of the league of a retail trader. Let's see. But you also mentioned that one should pick a sector and become an expert in it. Yes. But if someone is an expert in a particular sector, that sector may be leading or lagging based on economic cycles. Yes. And retail traders do not have the expertise or resource to do detailed analysis of each sector that is leading at a time and select the bellwether stocks from that sector. No, I agree with you there. I am not trying to find a shortcut, but would like to know what the best optimal path is. So I've done this video before. I call it the rings of risk, and the inner ring is the SPY. And then the next ring out are your 11 sectors. And they all have ETFs as well. There's an ETF for each particular sector. If you know nothing about the market as a whole, if you know nothing about any of the other sectors, you should either buy or sell SPY. You should either hold the market, and if you think the market is going down, you should be short the market. One of the two. But if you know something about one of the sectors, then you know enough to either overweight or underweight the sector, which means, well, I know this sector, so I can step into this sector and use that ETF. I still own SPY, and if I think that we're going into an expansionary period, I will add XLY, which is consumer discretionary, because when SPY goes up, XLY really goes up. If you think we're in a contraction, you can still own SPY, but you may short XLY, which means you're underweighting consumer discretionary within the SPY, so you're playing at just the level of the market and the level of the sector ETFs. As you get to know more about the sector, each sector in the next ring has industry groups. So you may say, well, there's one industry group that I really know well, and I know that this industry group does better than the XLY when the SPY is going up. So rather than XLY, I'll just get the ETF that tracks that particular industry group. And as you learn more about the industry group, you'll get down to the level of the industry, the sub-industry, and then the company. So as you gain more knowledge, you step out in each ring. If you know nothing about a particular sector, don't touch the sector. The sector's already in the SPY. It's already in the market itself. It's much easier for you to determine, is the market going up, is the market going sideways, or is it going down? And I think an easier approach altogether, and I'm going to just erase this top question here to give myself a little bit more room to write. Let's see. I think it's this one here. There we go. And I'm going to have to get rid of all the writing I did here. There we are. So here we are on a stock chart, and it looks like it's going down. There's been SPY for a period of time. If we look at a distribution, let's say options a 6 month out, there is a forward price that becomes the middle part of the distribution. It's always upward sloping because the forward price is a function of the risk-free rate. And then you'll have some distribution of prices here, and you may say, well, okay, I really don't know where it's going, but I don't think it's going over here. I think it may get to this level, but I don't think it's going over here. Well, sell this call. There you go. So you're selling this part of the distribution because you don't think it's going to get there. So there's always a play depending on what you know. And the more you know about the economy and the market and the direction of the market, the more you can play the distribution. As you become more familiar with each of the sectors, you can then play the sectors along with the market itself. So you may say, well, the market is going to be weak for a period of time. I can be long SPY. And then what I'll do is maybe instead of being long SPY, I'll take a half position in SPY, and I'll also be long XLP, XLV, and XLU. So I'm long staples, I'm long healthcare, and I'm long utilities because these will do better than the market will do. So the market may go down 10%. And these may only go down 4%. XLV probably wouldn't even go down by 4%. So that you are moving into sectors that you know are better than SPY for the type of market that you have. In the end, there's no short paper you can read or book you can read that when you're finished and close the last page, you go, aha, I know it all. The best that you can do is learn one thing. And remember that one thing and start applying that one thing, and then learn one more thing, and then add that one thing to what you know, then learn another thing and add that thing to what you know. This idea of, can I buy a book, read 15 chapters, and then I just know what's in the 15 chapters, it's very doubtful you'll remember anything you read. You have to practice it. And when you don't know what to do, when you're just starting out, you have two ETFs that you play with, SPY and TLT. There's your equities, there's your bonds. Where are interest rates going? That'll tell you what to do with TLT. What kind of market environment are we in? Are we in an expansion? Are we in a slowdown? Are we in a contraction? That'll tell you how much exposure you want to SPY, whether you want to increase your exposure or decrease your exposure. So you could be long SPY and say, I am worried about the upside, so what I'm going to do is I'm going to sell a call against the long position that I currently have. That'll lower your market exposure. Won't get rid of it, but it'll lower your market exposure. So if SPY drops, you get to keep all the premium of the call. You may still lose money on your portfolio. Your portfolio value may drop, but not by as much as it would have dropped had you not known to sell part of the distribution, right? Return experience. As far as doing a bottom-up analysis goes, in the bottom-up, you must have access to the applied series because you did watch the cross-security risk reversal video. You'll see one for agency and the steps that I go through. You have to understand, number one, you can start with a bottom-up approach. Pick a company. And the first question you ask is, how does this company make money? You first must understand how it makes money. Once you have that, then you say, well, what environment is the best environment for this company to do well, given that it makes money this way? And then ask, do we have that environment? Once you know what environment is the best environment for the company because of the way they make money, you know where all the risk factors are, and then you can say, well, do I expect the environment to become this, or to become more of this, or to become less of this? And then from there, you can determine whether this is a buy or a sell. Even if you don't like a company, you say the environment for this stock is terrible and it's going to get worse because the company makes money this way, its prospects aren't going to get too great. Well then, for something like that, I would sell upside calls. I'd sell out of the money calls because I think, it's not going to get there anyways. Let me sell some out of the money calls. And you can generate income that way because you think, well, given what I know about it, it's not getting there. So there's no wasted time in a bottom up. You can take any stock at random, you can analyze the stock and you say, how does it make money? What's the environment that's best for it to make money? Do we have that environment now? If not, are we going to have that environment going forward? There's always a trade, because there's always a buy or a sell, and there's always some part of the distribution is going to happen, or you feel is going to happen, and some part of the distribution of returns that is not going to happen. So when you step into options, you'll always end up with a play. Question is, based on the margin that you may have to post, is the premium as a percentage of the margin, in other words, the return on the invested capital that you have, the best use of your money? Well, then you have to sort of have other stocks that you can look at and say, well, which one's the best use of my money right now based on how much I can make for the margin I have to post? Okay, I've done level 1, but my career is moving towards real estate, commercial real estate investment firm. I was wondering if you could recommend any textbook. Much appreciated if you could find the answer, timely answer. I can do a step better than a textbook. We're going to look at the website for NCREI, Real Estate Investment Fiduciaries, and I'm going to show you all the education that you can get on there. It's endless, done by industry players. So you're getting something that's not in a textbook. It is incredible if this is what you want to learn. So I'll show you that in a second. What formula do you use to determine the amount of liquidity needed to reach 4065? I used A to B equals C to D as a rough estimate. And if D is your wild card, you multiply B times C and you multiply A times D and then solve for your missing variable. So let's say we have a market that is at 4,000 with a market cap of 32.5 trillion. That should be equal to 4010 on the index to X. Multiply these two together. Since you have the X over here, once you multiply these two together, you divide it by this amount, 4,000. So multiply the current market cap by where you think the market is going to go, 4010, divided by where the current market is, and it'll give you a dollar amount of what is needed to get, in terms of market cap, what is needed to get it there. And based on money flowing in, money flowing out, you're going to need a net inflow of that sum of money. And because we're doing at the index level, we can avoid things like overnight where prices just simply gap up because of good news, where money didn't have to flow in to get it there. All of that idiosyncratic stock level stuff should be washed out at the level of the index. It's a rough estimate. It's not exact to the penny. It is a rough estimate that gives you an idea of the types of money flows that would be required to get to the index to go to a certain point, and then you could begin to ask, is it reasonable, and who else is in competition for those money flows? About Walmart, I was listening to Walmart's earnings call, but since I don't have enough experience, I don't know how to interpret it. Nearly 15 analysts came and asked their questions. Walmart executives answered all of them, and I know they had a good quarter, though there were some worries about inventory levels and currency exchange rates. Well, because they did signal they had inventory problems before, so there's going to be questions there. And currency exchange rates, because the DXY was so strong, there's going to be some questions here, so that these analysts can then forecast out the effect of inventory levels, because that'll affect cash flows, and the effect of exchange rate, because that'll affect earnings per share as well. Apart from these, everything seemed to be very good. We know the companies are motivated to report higher numbers. Is it the same in earnings call when analysts ask questions? Not really. It's hard to bullshit a good analyst. They're going to know. If you try to sneak something past them, they're just going to call you on it on the call. There are some famous calls that were done in the past where management tried to, give a lowball answer to an analyst, and the analyst pushed back right on the call saying, hey, hang on a second there. So it would be difficult to try to try to just put forward the good stuff. If you want to adjust a company's revenue for inflation, how should you do it? Use ratios. Don't even bother trying to adjust for inflation. It's almost impossible. Let me explain why. A company may sell furniture. Well, you're not going to divide that by CPI, because CPI includes a whole bunch of other stuff. You want to find just the inflation rate for furniture for that category. And let's say that you can find it, but that the company discontinued a particular line. It no longer makes coffee tables, so its revenues dropped. Its earnings per share increased because it got rid of a losing line, well, you're going to have to adjust the revenue for all of the lines that were dropped and all of the lines that were added. What if it made a couch and it used a higher level of leather and also increased its price while it did that? Well, that's not inflation. That is a hedonic adjustment that you're going to have to use because, well, it's selling a higher quality product. It should have a higher price, but that price is not a result of inflation. You're going to have to adjust that differently. So it's very difficult to do. You can always find segment information, and you could look at, well, especially for auto companies, this is fairly straightforward to do. We sold X number of units this quarter. We sold X plus Y number of units last quarter, and you can figure out what the increase in real units are. But what if these units it sold were of had less trim or had more trim? Then that becomes difficult to do as well. However, if you have a number like earnings per share, EPS, which is a nominal number, and you divide it by another nominal number like price, take price and divide by EPS, you will get a multiple, right? You'll get a PE multiple. Well, a PE multiple has no units. So you can compare based on PE multiples and not have to worry about real versus nominal. Same with profit margins, net income margin, gross margin. Those are unitless because you're dividing a nominal number by a nominal number. The dollars disappear and you're left with a unitless number. So the short answer is don't even bother trying to adjust the revenue for inflation. Who cares? Just look at you look at the ratios. If there is a decrease in quantity, it'll be disclosed in the conference call. Also in the notes to the financial statements, if there's segment information, it will give you the increase or decrease if it's clear enough to write the increase or decrease in quantities. About the CAPM formula for valuation, when you want to calculate the RM factor, how long should your period be? As long as possible. CAPM is what's called an equilibrium model, and it assumes a market in equilibrium because everything is priced off of beta. So everything, the expected return you should get on your stock is some function of its risk in relation to the market. So being that it's an equilibrium model, we don't want to take a period of time where the market was out of equilibrium, like a 3-year period. Over a long period of time, if we assume that here's an equilibrium level for the market, at times the market will have valuations above, below, but over a long period of time, we would expect the geometric return, which is the compounded rate of return, the geometric return, to be an equilibrium level. So for as long as you can. Okay, this is the site for NCREIF. This is the National Council for Real Estate Investment Fiduciaries. And when you land, you'll have a whole bunch of menus here. Click on Research. There's different research papers. Some of them you may not find relevant to what you want to know. However, it is worth reading some of these research papers because they do cite other research, which means you can go to the references and you can look for, it's the best source to find other references to read. You go to the footnotes and where they cited all of the authors, you can look at the different papers and some of the titles there. You may say, aha, that's an interesting title. You click on Show All and it'll show everything. Whole bunch of stuff here, academic papers as well, lots of research that you can see there. Education and webinars, and lots here as well. This one is Essentials of Institutional Real Estate, Introduction to Reporting Standards. You get it, right? You just scroll down, lots to see there. Conferences is pretty exciting as well. Click on Conferences. And they'll tell you the upcoming conferences. You have past conferences. Click on more information on a past conference and scroll down. Climate risk modeling. Look at this. You've got a whole bunch of interesting stuff here. Well, let's see how you deal with that. And they give you a presentation. That's the same presentation they presented at the conference. So you can go through these things. A whole bunch of great information. It may not be information you're looking for, but then again, how do you know what you're looking for when you're just learning something, right? So when you're learning, you just jump in. You just jump in and you start learning about stuff. And pretty soon that puzzle that you're trying to put together will come into focus. And you'll say, okay, well, I know something about this now and I know something about that. And you'll find another reference that fills in another piece of the puzzle. Don't try to look for one source that will walk you through everything you need to know from A to Z. Just jump in. You may fill in the letter M, then you find something that fills in the letter B, then you find something that fills in the letter T, and eventually you'll have the whole alphabet, but you'll do it out of order, and you'll do it opportunistically as the information presents itself. So this site, the NCREIF site, has a whole bunch of really great stuff for you. If you're leaning more towards private REITs or REIT structures, there's NAREIT, NAREIT. It has a whole bunch of stuff, but it's really REIT focused. So hope that helps. Could you please describe the structure of the financial services sector? Oh, that's a big question. My question really is about asset management and investment management, as I don't understand what the difference is. I was hoping to understand the sector as a whole and the main difference between the distinct industries to help me understand the difference. Okay, well, that's easy enough. Let's say that you're going to an investment management firm. Here is your guy right here. Let's put that fine arts degree to work. You go see this guy. He says, yeah, I can manage your money for you. And then he will send it off to different investments. He may send it off to equities. He may send it off to fixed income and some to real estate. And that's what this guy does to you. He talks to you, and every year you visit him and you tell him about your change in situations, and he will do changes in the allocation. The person managing this equity portfolio is managing assets. That is an asset manager. The asset manager does not talk to you. So investment management is more like private wealth management, whereas asset management is you're running a portfolio of assets and you're concerned about the portfolio of assets without any care for any one particular client. You're managing it to the IPS that you have, and clients come to you because your mandate matches what they need, right? So hopefully that'll help. Could you please develop a bit more on term SOFR? LIBOR was supposed to reflect the cost of interbank borrowing, which is not secured, while SOFR is actually a rate which is secured by treasuries. How is the SOFR then different from a rate on the underlying collateral? In other words, if the idea is to have a risk-free rate, why cannot we just look at the 1-month T-bill? You can look at the 1-month T-bill. Many thanks, and again, for your content. It comes down to the frequency. I shouldn't say the frequency, but the number of observations you have on a yield curve. So if you were going out 1 year on a particular curve, 1 month, 2 month, 3 month, 4 month, let's say 1 day, 1 week, 2 week, 4 week, 1 in 2 months, 3 months, you can get a 1 month, a 2 month, a 3 month, a 4 month, a 6 month, and a 1 year from the treasury curve. Whereas with SOFR, you can get a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. You can get one for each month. It has more rates, and it's a smoother curve. It also is the rate at which banks will lend to each other because, well, a bank is not the government, right? So you'll have to collateralize your loan, and you'll get very close to a government rate because you've secured the loan that you want with government securities. There are just more maturities, and it is a smoother curve. So if you're doing any kind of derivative work, you're going to need something with more frequencies than what the treasury curve can give you. So you'll use the interbank curve to get that done. Almost all derivatives are priced using interbank. Well, I think, no, not almost all derivatives are priced using interbank rates. Currencies are priced using interbank rates as well. So when we look at currency forwards, it is the interest rate differentials based on interbank rates, not based on treasury rates. It's based on what a bank deposit can get you over that period of time, which is an interbank rate. It's just a smoother curve and one with more frequencies, so it becomes easier to work with. Let's see, do you have any plans for starting lessons on CSC? I used to have the CSC on my site. Moody's owns the CSC now. And Moody's delivers the CSC. When you pay Moody's for the CSC course, you get my videos. I sold them. They were on YouTube. I sold the series to them and upgraded it, which means that I upgraded to their current. The one that was on YouTube was old. I upgraded to their current one. And now when you sign up for the CSC course, you get my videos. They're already there, so I already have them done. Any chance you'll add a recession theme section to your applied macro top-down? Absolutely yes. It is difficult to do a a phase of the business cycle unless you're in that phase of the business cycle, because if you're not, everything is theoretical. It would be like you would see this and you would see that and you would do this and you would do that, but there's nothing to show you that because that has not happened yet. So the thinking is that we are going to enter a recession in the first or second quarter of 2023. Canada will probably enter one before the US, and if that is the case, then I will do a top-down analysis using the recession phase of the business cycle to use Canada as an example of the types of things that we would see and what we would expect, so that while the recession unfolds, we can then see whether or not those things actually do happen. So you want to do it as close to that particular phase as you can. I've done the slowdown phase, which is what we're in right now. So as you go through that video, you should recognize that, hey, that's exactly what I'm seeing right now. That's how we know we're in the slowdown phase, is when you start seeing all of those indicators doing exactly what they should be doing in the slowdown phase. I will be doing one for the contraction phase. We don't call it recession. The business cycle doesn't call it a recession. It's just called a contraction. So you have your recovery, your expansion, your slowdown, your contraction. And this over here is your recovery. There's your expansion. There's your slowdown. There's your contraction. We're here. We're thinking we're going here. Unless we get a soft landing and we go into another expansion, then the next video will be about recovery and expansion.